Hi friends, welcome to the channel JIV and CIV Made Simple. This is our ABM Crash Course Day 6 and our topic of discussion is Unit 23, which is based on risk management and credit rating. So if we talk about the weightage of this particular chapter, particularly 2 to 3 number question is asked from this particular chapter, and obviously it is very short chapter. So we will go through the key points of this particular chapter. So let's get started with our first topic. First of all, let's talk about a key concept in banking and finance, right? So the first thing is the credit risk and your credit risk. So you can imagine this credit risk like a keychain holding several key that unlock the reason behind potential financial trouble. So what is the meaning of credit risk? You know the meaning of credit risk? It simply means that possibility that a borrower may fail to meet their financial obligation. But what really drive this risk? First, we have something called external factor. So basically forces from outside the bank control. External factor are those forces which are outside from the bank control, and these include some factors like economic shift, exchange rate, interest movement in the exchange rate, movement in the interest rate, political instability, right? So these are some of the reason behind this external factor. For example, if a government suddenly changes its policy or a major currency devalue, so borrower might struggle to repay loan, raising the credit risk, right? And the second factor is called internal risk. So these are within the bank control. So external risk means outside the bank control, which bank cannot control, right? Outside bank control. And if we talk about the internal factor which is within the bank control, right? Like example, poor credit appraisal, right? Suppose the bank has done poor loan structuring, inadequate credit appraisal, right? Excessive exposure to a specific industry, or a weak loan monitoring system, all highlighten the risk. So even lending too heavily to one sector or region without diversification can be dangerous. So mastering credit risk means understanding both the external storm and the internal crack. Only then a bank can safeguard itself and its client, right? So these are the two kinds of credit risk: external risk and internal risk. External factor, internal factor. Now let's let's see the classification of how this external environment and internal environment goes about. So friends, when we break down credit risk, it is split into two broad categories, like two distinct branches of the same tree. First form the external environment and the second form the internal environment. So external environment here is what we call portfolio risk. This is about the bigger picture, and two major type stands out here. Concentration risk, which means when too much credit is concentrated in one particular sector or borrower, making the portfolio vulnerable. Or industry risk, suppose in ban, which depends on how industry perform. If industry face a downturn, all loan linked to it might be at risk. On the other hand, there is something called internal environment, the bank on operation, right? And here we face the transaction risk. So this is more deal specific and includes several risks like default risk, which means when a borrower fail to repay, or spread risk, which relate to the change in the pricing of the loan, or downgrade risk, which means when the borrower credit rating fall. What is the meaning of downgrade? So suppose the borrower credit rating it falls, this is called downgrade risk. Obviously it increases the risk. And finally we have recovery risk. What is the meaning of recovery risk? So basically it is about how much can actually be recovered if things goes wrong. So while portfolio risk save the broader credit landscape, transaction risk emerge right at the deal table. Both demand sharp attention to keep credit risk under control. So either it is portfolio risk or transaction risk. Both demand sharp control, right? Close monitoring. Now let's switch our focus to our next topic, which is credit rating agencies and RBI regulation. So the peculiarity of this crash course is that in this crash course you get everything in pictorial format. So at the time of revising this particular chapter, you only go through this picture and everything is clear. No need to go through that book, because this is a kind of mind map. It remain in your mind for a longer time, and this is what we provide in this crash course. For more detail regarding the crash course, you can WhatsApp me on this particular number, right? So now let's discuss this RBI regulation on credit rating. So friends, let's dive into the world of credit rating agency and how the RBI keeps them in check. Credit rating is very vital in assessing the financial health of a borrower. But who gives this rating? So there is something called domestic agency. Last time question was asked, which of the following is not a domestic agency? So these domestic agency operate within India. So this includes CAIIB, CRISIL, Indian Rating, ICRA, Brickwork and Acute. They focus on evaluating Indian company and their credit worthiness. And then we have some global player, right? Like Fitch, Moody's, S&P, right? So these giant assess companies and sovereign worldwide. So all these agencies work under the umbrella of the RBI regulation on credit rating, right? So the RBI ensured that these agencies follow guidelines to maintain transparency and reliability, especially domestic agency we are talking about. And what about the banks? So they rely on these rating to estimate the probability of default, PED, right? The chance that a borrower might fail to repay. Additionally, under RBI AIRB, what is AIRB? AIRB full form is Advanced Internal Rating Based Approach. I think you know about it. Operational risk measurement, there is an approach called Advanced Internal Rating Based Approach. So under RBI AIRB, bank refine their risk model to make lending decision smarter and safer. So I hope that makes sense to you. What is credit rating agency and what is the RBI regulation? Now let's shift our focus to our next topic, which is none but overview of the CRILC. CRILC is a very important topic, and let me explain each and every part of it. So let's break down the CRILC reporting system, which is a very critical tool for managing large borrower risk. First of all, large borrower risk is involved. So first thing, what is CRILC? The full form is, let me write down the full form. It stands for Central Repository, Central Repository of Information on Large Credit. So it stands for Central Repository of Information on Large Credit. So, and its reporting system is mandated by RBI, right? So basically what happened, first thing is the reporting requirement. See, bank must report data for all borrower who have exposure, whether fund based or non-fund based, of 5 crore and above. So whoever has exposure of 5 crore and above, whether it is fund based or whether it is non-fund based, does not matter. Bank must report data for all borrower, right? So this include account classified under, because this include account classified under SMA. What is SMA? SMA means special mention account. But note, crop loan are excluded. Crop loan is not included, right? Although other agriculture loan still need to be reported, right? So what I am saying you, that bank must report data for all borrower who have exposure, whether fund based or non-fund based, of 5 crore and above. This include account classified as SMA. SMA is also included, a special mention account. But note, crop loan are not included, right? Although other agriculture loan still needs to be reported. So agriculture loan is also various type. So especially crop loan is excluding, and other reports, other loans should be including. Exemptions are there. What exemptions are there? So not everything goes into CRILC. Exposure to institute like NABARD, SIDBI, Exim Bank, NHB, these are exempted. Now there is something called PAN master record. Please try to understand what is the meaning of this PAN master record. So let me explain what it is saying. That here it is written that it says that even if there is no exposure, bank must still report outstanding current account balance of 1 crore and above based on the PAN master record. So you can say bank must report outstanding current account balance of 1 crore and above even if no exposure exists, right? So based on the PAN master record as per the RBI guideline rolled out in February and May 2024. So in short, you can think of the CRILC as an umbrella protecting the financial system by identifying early sign of stress among large borrower. So basically it deals with a large borrower because the full form itself says, right? Okay, so what is the full form of CRILC? I already told you that basically it stands for Central Repository of Information on Large Credit. So LC means large credit. So that is why it deals with the large credit only. Now let's go through the history of this establishment and regulation of CICs in India. So friends, let's walk through the journey of how CIC, how credit information got organized and regulated in India. It all started back in 1999, right? So when RBI formed a working group, so there is a WG which is called working group, which is formed by RBI. Why? So why this working group was formed? So this working group was formed to study the credit information system in India. So basically the main purpose was to study the credit information system in India, how it works. So this group does not stop at the research. They went ahead and recommended the creation of a formal credit bureau. They recommended the formation of a formal credit bureau to strengthen the financial transparency, right? Then comes civil, right? Then civil was established. You know what is the meaning of civil, right? So basically civil was the India's first credit bureau, which was set up by SBI and HDFC in 2001. But that was not the end. Soon after, India saw the creation of 3 more CIC. The first civil was established, remember, civil and as SBI and HDFC, and 3 additional CIC were established, right, to widen the credit information network. Fast forward to 2005, right, the RBI introduced a landmark regulation mandating that all financial institutions must be the member of at least one CIC under the Credit Information Companies Act. So basically there was an act which says that every financial institution should be a member of at least one CIC. Now RBI did not stop there. They also issued a directive asking bank and financial institutions to join all CIC to ensure seamless data sharing. To join all CIC further. Earlier they say only one CIC, later they say all CIC. Now lastly, speaking of membership, RBI put a cap on fee, which is rupees 10,000 for joining and 5,000 annually for reporting, making it affordable and consistent. Lastly, bank and financial institution were instructed to actively report defaulter with exposure of 25 lakh and above. Right. So these are the points as per RBI directive. Now let's understand the credit default swap. So friends, let's decode the concept of CDS, which is called credit default swap. It's like an insurance policy for lender. First we have the protection buyer. The first we have is the PB. In short, we call it the protection buyer. Basically, this is typically a lender or an investor worried about a borrower defaulting on a loan. He is worried that a borrower will default on the loan, right? So this is an investor or a lender. So they seek protection against this risk. On the other hand, we have the protection seller. So basically, usually an insurance company or a financial institution that agree to provide coverage if the default happen. So this will provide the coverage to whom? To the buyer if the default happen. So this brings us to the premium payment, right? A regular fee paid by the buyer to the seller, like just you pay premium on insurance policy. Now question is, who or what is this protection about? So what is this protection about? So that is where the reference entity comes in. It could be a company, it could be government whose bond or loan are at risk of default, right? It could be a company whose bond is at risk of default. It could be government whose bond is at the risk of default. So basically, if the reference entity default, the protection seller compensate the buyer, which means underlying asset which is under default condition, right? Who protect the buyer? Protection seller protect the buyer. And tying it all together are the ISDA terms, basically, which are a standardized rule and agreement that govern how this swap work, ensuring clarity and consistency globally. So you can think of this CDS as the key financial tool that unlock risk management option in the lending world. I hope that makes sense to you. Please hit that like button if you think that this information is really useful and it is presented in such a lucid way that you can easily revise at the time of examination. Now the next point we have is called CLN, credit link note. So let's take a walk through the fascinating world of the credit link note cycle, a powerful risk management tool in finance. First of all, it all begins with risk seller paying the premium. You see, risk seller paying the premium. So the entity exposed to the credit risk, right? Let's them call risk seller. He pay the premium to a special purpose vehicle or SPV, right? To transfer that risk. Then step number 2, SPV issues CLN. SPV, special purpose vehicle. So basically, credit linked notes are issued by SPV, and these notes are directly linked to the credit risk that the seller want to manage. So these notes are linked to the credit risk that the seller want to manage. And then what happened? Then step number 3 comes. Then comes the investor who purchased CLN, hoping for attractive return in exchange for taking on the credit risk. So these investors take the credit risk. In exchange for that credit risk, they hope the return. And then what happened? Step number 4, what SPV do with this money? SPV, so whatever investor have invested money, what SPV do with this money? So SPV invest proceed wisely, used usually in safe high quality security to balance the risk, right? So invest the proceed in a high quality security to balance the risk. But wait, if there is in trouble brewing, we check the default occur. So if yes, the next step is trigger. What is the next step? That in case of default, the SPV steps in to liquidate the security which is bought, right, from the payment is received from investor. SPV liquidate it, right, and then the fund from this liquidation are used to compensate the risk seller. But if all goes well and there is no default, SPV will simply return proceed to the investor, right? If all goes, because this investor take the risk, right? They take the credit risk, and if everything goes well, right, return proceed to the investor along with their return. So that is how it happened. And just like that, the CLN cycle is complete, a smart way to transfer and manage credit risk in the financial market. So depending on default happen or not, the next step is taken. So this is all you need to know about this credit risk policy, CLN, credit link note. Let's now dive into the credit risk management guideline, the backbone of sound lending practice in bank. So first of all, let's talk about infrastructure project analysis. Banks are advised to conduct thorough due diligence through, first thing, the method is called sensitivity analysis. You know what it is? Means it is used to assess how change in key variable affect the project. So there, a project depends on many various factor, and if you change each and every factor, how it affect overall project, this is called sensitivity analysis. Second is called scenario analysis. It helps us prepare for multiple possible outcome, right? There are multiple possible outcome. So multiple outcome, it helps us to prepare for multiple outcomes. Then we have the risk of delays and the cost overrun. Basically these two things, basically evaluating these two things, let's be honest, in infrastructure surprises are common. So risk of delays are there and cost overrun is also there. Cost overrun is what, that sometimes we expect only 10 crore and the actual cost become 11 crore. This is called cost overrun. Next we have independent credit appraisal. So RBI suggests avoiding external consultant and promoting objective in-house assessment. Why? Because independent eye ensure a sharper focus on the actual credit worthiness. And the third is promoter equity verification. Bank must verify the source of equity. RBI here is crystal clear. Watch out for disguised debt. Watch out for disguised debt. RBI is crystal clear here that watch out for disguised debt where parent company loan are camouflaged on equity in subsidiary or SPV. So basically no parent company is disguised as equity in the subsidiary or SPV, right? So that is the point. So this is called disguised debt where parent company loans are camouflaged as equity in the subsidiary or SPV. Now you may ask me, how should bank actually manage credit risk and monitor fund in real time? So how should bank actually manage the credit risk and monitor fund in real time? So that is where this point come. DIN. DIN is used for identification. This help ensure director are properly identified, avoiding any wrongful credit denial. Then we have, you have to cross check the name, which means a bank should match director name against defaulter list to reduce the chance of risk exposure, and also to engage auditor directly, which means bringing in independent auditor allow bank to closely track how funds are used. And finally including covenant. What is covenant? Basically adding a smart clause in the loan agreement ensure tighter control over fund utilization. So in short, the RBI guideline help banks stay vigilant, make informed lending decision, and protect themselves from the hidden risk. So that is the point all about it. Now let's talk about the last slide, that is the credit risk management cycle. So friends, let's explore the credit risk management cycle, a continuous loop that safeguard a bank's financial health and promote responsible lending. First thing is called strengthening risk management. So at the heart of it all, the bank must constantly refine and enhance their credit risk management framework and policy. A stronger system means fewer surprise down the line. Then the second thing is improve the asset quality, right? Which means next focus shift to building a portfolio of high quality asset. HQLA, high quality asset, right? HQA. So remember, healthy asset means healthy balance sheet. The next thing timely recognize stress. So here is the third point, that the timely recognize stress asset. So basically what happened when asset starts showing sign of stress? So bank must quickly identify and address stress asset to prevent deterioration. And then regular CAIIB reporting. I told you about this CAIIB, right? So basically transparency is the key. Bank are required to consistently report to central repository of information on large credit, keeping regulators in loop, right? And finally review borrower classification. So banks should regularly assess the classification of borrower. Are they performing? Are they slipping into default territory? Are they in SMA1? Are they in SMA2? Whatever it is. So by following this dynamic cycle, bank can minimize risk, safeguard their capital, and promote responsible credit practice. And that is all you need to know about this chapter, nothing else. If you have understood that this much, I argue, right, I guarantee that no any extra question will be asked, right? So that is all about this particular crash course. Now I request you to please go through the MCQs PDF and quizzes which I have provided in the folder. Please go through them, and for more detail regarding the crash course, please WhatsApp me on this number. Stay tuned, do subscribe the channel. I will share the next video soon. Thank you.